Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. We have Rajesh Kothari with us, founder and managing director of AlfAccurate. Rajesh, what do you attribute the recent market jitters to?
Hi, Neeraj. I think volatility is a new mantra of market from last couple of years, particularly post-COVID. And I think volatility is going to increase further because of one or other reasons, be it a geopolitical, be it a local elections, be it a state elections. And I think every month there is one new factor which comes into the this game of volatility. So investor need to get adjusted to the heightened volatility, but one should not get fearful. One should try to consider volatility as your friend, treat it as your friend, and try to optimize as best as you can. Don't panic when markets are at low, and don't be too greedy when markets are at kind of a very high levels. And I think that's going to be the so at our investment house, we always believe, therefore, our style is cogility. Be quality conscious in what you buy and be agile enough to get out of it. And only this combination is going to work out in future as well.
Rajesh, have you built out a bit of cash in your positions, or are you fully invested currently?
Neeraj, generally we have seen that cash component doesn't make that big difference to your portfolio, because irrespective of what kind of state of market is, there are always sectors and companies which will basically do well compared to the other set of companies and sectors. So for example, healthcare is one sector where we have increased our weightage. We have reduced a little bit from cyclicals and added a little bit to pharmaceutical as a sector since last 2.5, 3 months. And I think if market enters into kind of a consolidation or more volatile zone, and also as the pharma company starts delivering better earnings growth, and that's what our assumption is, I think healthcare sector can be very interesting opportunity. So, we were almost like a 0% in healthcare, less than 2%. From there, right now, we are almost 6.5% weightage to pharmaceutical. And likewise, so we always find opportunities within sectors, across sectors, and that's how probably cash is not that important.
Got it. Okay, so interesting. By healthcare, it's largely pharma, or does it expand into hospitals, into diagnostics, so on and so forth as well?
So the healthcare covers the entire spectrum, but currently what we own is more of a CDMO players, because this is a segment where we have seen that this segment is impacted significantly post-COVID, because budgets from the US, the R&D guys that have reduced, and from now on, we are probably at the bottom of the cycle. Most CDMO players have not done well in last 2.5, 3 years, despite the long-term very exciting opportunity. So I think we are at the probably the worst of the cycle, and from now on, the CDMO players R&D spend should start moving up, and that should help the few leading companies who have positioned themselves well to gain significantly from this trend.
Interesting. So, Rajesh, in some sense, you are preempting what could happen a couple of quarters out, right? Because commentaries from a Loras, I think from a Syngene, all of that suggested that it's maybe 2 quarters out, but that's when it will start coming back, the CDMO spends.
Absolutely. You need to be a little bit ahead of time. You can't be just in time. Markets are very, very efficient.
Yeah,
and
sure.
At times you need to keep 1 or 2 quarters patience. But if you believe that in 2-3 years, companies can deliver 18, 20, 25% compounded earnings growth, that's, I think, fantastic compared to Nifty earnings growth of, say, FY25 is going to be likely to be around 12%. So 12 versus, that 20, 25%, definitely, that's basically what, excites us.
Got it. Rajesh, what do you make of the commentary from Larsen and Toubro, for example, wherein they've spoken about how the election season might hamper the guidance for FY25 as well as the order inflow for FY25? Is that a negative? Or is that priced into businesses like L&T and some others in the construction stroke infra space?
So I think, specific to the name, what you mentioned, there are 2 components of it, domestic business and international business. The more muted kind of a, guidance is more on the international side. Domestic side, it is only a quarter kind of a thing, because during election time, everybody knows that no major capex new announcements or the actual project commencement, all these things basically get kind of a hold kind of thing. But you are also aware that because it is on hold, that's why in 4th quarter they get most of the orders before election. And in capital goods, people focus on order intake rather than the revenue. Current order intake becomes your future revenue and then future profit as projects get executed. So I think international is a little bit more worrisome right now compared to domestic. And since the company, what you mentioned, is having 2 major segments, both on domestic as well as international, that kind of, to a certain extent, that's why Street has a little bit downgraded their numbers.
Okay, okay, but
We
does
currently do not own, that name. Just to put a disclaimer, we do not
got
own
it.
that name right now in the
Got it.
portfolio.
Yeah, but do you believe that it could be a bit of a cloud on the overall construction infra space, that maybe the election season curtailment might last not just till June 4th, but maybe a month until post that as well, until the budgets are out, therefore maybe avoid that pocket or nothing like that?
No, I think the markets are very, very efficient enough. So market is already discounting that for next 3 to 4 to 5 months, probably maybe up to September, you may not see a large new orders. But then what will happen? Everything will bunch up in December and March. So whether you should play for June or whether you should play for December or whether you should play for March. And that's why a little bit you need to keep a little bit, medium to long term view. I'm not saying take 10 years view, but at the same time, don't take just 1 quarter view. And importantly, most important, Neeraj, is you need to keep factoring what is priced in. Whether my stock is already discounting 30% order intake for next 3 years, then probably everything is priced in, and I need to be little bit margin of safety is not in our favor. But if you think it is only 10% compounded order intake is priced in, then probably there is a positive surprise for investors.
Makes sense. Rajesh, the other aspect is what's happening to businesses like Asian Paints, for example. I mean, we've seen the last 2 years, DMart virtually go nowhere except for the last 3 months, let's say. But there was a time period correction. For Asian Paints, we've seen the same. And now that heightened competitive intensity, presumably, is bringing out a margin correction as well in a business which is blue chip, showing volume growth. But people are being a bit hesitant. What is your own thesis of what to do with some of these expensive stocks which might be showing volume growth, but we don't quite know if the revenue growth will match that volume growth?
I think you are on dot, Neeraj. I think what is most important is the profit growth. Ultimately, that's what we all are paying for. And historically, if you look at many of these companies, again, there are two buckets. There are companies which have delivered 18, 20, 25% earnings growth. And there are companies which are, of course, blue chip companies, extremely expensive, but reported only 10% compounded profit growth for last 10 years. So there is a distinction between these two categories. Am I right? There are two buckets. And as a fund manager, our focus is where we expect the growth over next 2 to 3 to 5 years. Do we expect them to do 15, 20%? If yes, then of course look at valuation and keep selecting. So for example, in that kind of a bucket, we own, for example, please put a disclaimer, like Pidilite. We own Pidilite. And we like this business. We believe that company is doing extremely well. Even if you look at the last quarter, the volume growth has been exceptionally strong. And underlying demand drivers are absolutely intact. Unlike many other players, the competition is very limited for companies like Pidilite. And I think as the real estate demand, because it is 2.5, 3 years lag effect of what gets announced compared to when the waterproofing and everything starts, it takes 2.5, 3 years. So real estate demand now actually of last 2 years will result into revenue for companies like Pidilite. Yeah. So I think there are some businesses which are positioned for 18% kind of a plus earnings growth over next 2.5, 3 years, and those are the businesses which we would love to own rather than just having a blue chip but 10% earnings growth.
That's a fair call, and thanks, Rajesh, for that as well. One more question, Rajesh. Because you in the past been a believer and probably still are a believer of quality businesses. You mentioned that in this interaction as well. And that is not to say PSU banks are not quality. Some of them are extremely great quality. But the last 4 years, the valuation gap between PSU banks and private banks, at least the largest PSU bank and some of the private banks, has narrowed a little bit. There's still some gap there. But as a basket, PSU banks has outperformed private banks over the last 4 years now. Do you think there is merit in this outperformance continuing, or is there a valid reason for large private banks to make a comeback, if you believe banks will do well, that is?
Well, Neeraj, again, very, very, very right question what you ask. And I think my view is probably both can do well.
Okay.
Right. Of course, then one needs to go company specific.
Yeah.
But there is a reason why the PSU banks got re-rated, because first they got de-rated. So whether 0.3 is a right valuation or 0.9 is a price valuation, it can be a subject of debate. But they de-rated first. Simultaneously, private sector banks got re-rated from 3 times price to book to 6 times price to book. PSU banks got de-rated from 1.5 times to 0.4 price to book. Last 4 years, 0.4 has moved to 1.1 and 6 has become 3. So right now it is 3 and here it is 1.1. Gap is still big. I'm not saying both will trade at same valuation. Then of course you need to do a case by case evaluation that what kind of risk you would like to basically take, and the policy risk and uncertainty, and whether you think the management has basically changed these institutions to becoming more systematic. And I think the good point, Neeraj, is look at RBI. I think RBI is doing a super job, and they are making sure that the entire banking sector gets protected in such a way that even whether it is a project loan, whether it is a construction loan, whether it is a disclosure norms, whether it is a provision norms, be it a retail, be it unsecured, be it a credit card, be it a project finance, across the board, they are tightening the entire system to make sure that the credit cost remains low. That's very, very important, because you are cushioning the banks enough for the future shocks. And it means basically they are suggesting to the bankers that please be conservative. It is very easy to lend money to someone, but it's
Yeah.
very difficult to get it back. And I think that basically leads to a little bit kind of a re-rating structurally, in my view, for even PSU banks. And we own both. We own PSUs, we own private, we own NBFCs.
Right.
So, there is no difference for us. Of course, we need to be selective within that.
Great answers, Rajesh. Lovely having you. Look forward to having you more. But thanks so much for joining in today and giving us your thoughts.
Thank you, Neeraj.
Hello and welcome to Earnings Edge on NDTV Profit. My guest today is from Larsen & Toubro, Mr. Shankar Raman, who is the President, Whole-Time Director and CFO of the company. Mr. Raman, thank you very much for joining us on NDTV Profit. We've seen your numbers. We just wanted to assess how the economic climate is with respect to infra projects, because we've seen some kind of slowdown happening in Q4, and that you predicted as well, because going into an election there may be some slowdown. But how do you see FY24, and when do you see this see the pickup in orders coming in?
Good morning, Sajid. Good morning to all the viewers. I think we are extremely positive about the months that are lying ahead in the rest of the financial year. It is to be expected that when we have a major national event like an election, that there is going to be some amount of interruption to the normal flow of transactions, particularly when it involves capital outlay and investment programs. But the good news is much of the programs that were launched over the last 3.5 years are well into their execution phase, and many of them are also nearing completion. So what we expect to happen, let's say post July, August, when the new government settles down, the bureaucracy assumes charge, etc., is a completion of a lot of these which are pending completion, which will feature the initial period. But we expect the government to sustain their investment-led growth program. If you really look back, this model has played very well out for the government, both from an economic point of view and also from a political point of view. I think we've been able to address a lot of social issues in the process of creating and strengthening the infrastructure of the country. Obviously, trade and commerce have benefited, and those are borne out by numbers. I think India stands out as such a shining alternate to the gloom and doom that we see in the economies elsewhere. Either they are caught up in military strife and geopolitical tensions, or they're really caught up in the inflationary spiral. And many of them are going through stagflation as well. So India is a very refreshing change, and I think we are quite fortunate that we are in our business staying very relevant to the growth model that India is pursuing. So we are optimistic. I think from July, August, we expect things to get back to normal.
Give us a sense of the kind of prospective pipeline that we see in FY25, and do you see order inflows or the tender openings happening only post July, August, and so the second half would be much more concentrated with respect to the kind of order flow that will come in?
Sajid, it will happen in two parts. One is all the bids that have been responded to the request for proposals will get processed and get opened. So that will be the first one. Assuming there is continuity of the economic policy, I think we should expect those awards to come in and then the programs to get kick-started. The second part of this is new programs. Now, there are several programs which are actually initial packages of a large nationwide connectivity. be it the rail corridor, be it the interland connection, be it the trade corridors, the logistics distribution systems. There are several things which are in their initial phases. The country over the last 3-4 years have invested in some segments of those, and those would require completion, because the economic benefit of those programs will really flow through only if they are completed end to end. And we do think the country will get connected increasingly over the next 10 years. The country will get connected fairly deeply by multi-mode. And that could ensure that a company like us, who straddle various segments of infrastructure, remain very busy and relevant.
Sir, if I look at your guidance, you've given a 10% growth guidance for the order inflow. If we translate that into what it's going to come through in domestic order inflow, you is looking at the domestic order book or order inflows going up by nearly 30% in FY25. Do you see the way the orders will flow out, you'll be able to do that? And also give me an assessment of how order flows are coming from the Middle East, because there is one thought that there has been peaking of orders coming from Middle East, and so there will be some slowdown that's coming from there.
It has to be looked in the context of FY25 being really a 7, 8, 9 month period. So when we talk about a 10% growth for FY25, it virtually on an annualized basis could mean upwards of 15%. So on the back of a 30% growth in FY24, a 15% growth is a fairly robust estimation of the opportunity. When we look at the opportunity pipeline on a trailing 12, on a forward 12-month basis, we almost are arriving at somewhere between 12 and 13 lakh crore of prospects. Roughly about 7 lakh crore is Indian opportunity and 5.5 lakh crore is international opportunity. The Indian opportunities are spread across the various sub-elements of infrastructure and energy. I think the energy transition is a major catalyst for some of the investments that would happen in the energy area. Then we look at international. I think Middle East has been a large contributory. And the changing dynamics in Middle East is very noteworthy. Earlier, Middle East used to be largely projects in the area of oil and gas. But over the last 5 years or so, Middle East has started broad-basing its infrastructure development program. It has started building cities. Middle East was always known for road connectivity. It started developing rail connectivity and also urban transportation. Fact that Middle East is getting positioned as a destination for tourists. Dubai was always that, but beyond Dubai, Middle East was not really known for a destination for tourists, and that is changing. The socio-economic order also in some of the conservative countries there are changing. Given all that and the need for that local population to be gainfully employed, the investment programs funded largely by the steady oil price at about $80 or thereabout per barrel is giving confidence to the government that they should embark on building cities, building roadways. And when you talk about building cities, you talk about rail network, water network, sewage treatment, and theme parks, and what have you. So all of this together makes Middle East almost mirroring India in terms of potential for the breadth of infrastructure investment. And L&T feels quite privileged that its capability has got demonstrated in that market over 20 years. I think wisdom of our earlier generation of leaders positioned L&T as a very credible player in the markets. And year on year, we've been delivering projects to the Middle Eastern customers. So between India and Middle East, I think we are bang in the middle of extremely positive 10, 15-year period.
My last question to you is on your strategic vision, because you mentioned that 14% CAGR growth for order inflow and 15% for sales is the target by 2026. And so far, actually, you have been ahead of the target. If I look from FY21 to 24, it's around 20% in order inflow and 18% in sales. Do you expect to continue with this kind of growth rate? Because this year may be a blip, but it may, next year or the year after. Do you see the FI CAGR to be in the same range by FY26?
I think we are at the moment, as you rightly said, running ahead of the plan. We hope to hang on to that lead and enter the last year of the plan with sufficient cushion in the bag. In all probability, both in terms of order inflow and in revenue, we will outperform the plan as we see it today. Of course, this has to be assessed because another 2 years have to go past. And in the third parameter, which is profitability measured by ROE, we had guided the market that our aspiration is to reach 18%. As we speak now, we are at 15%. We started the journey at 9. So we've come a long way from 9% to 15% through capital efficiency, productivity improvement, profitability improvement, etc. We expect to continue on that path and hopefully meet that target as well. So we are expecting successful completion of the 5-year plan as we see things today.
Mr. Shankar Raman, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit.